Make sure you record the class. You share with the rest of the students. Maybe you can create an email for the class. That's where you will send. Some of the gadgets cannot accommodate the whole recordings. So in our first class, we discussed our course outline. I know most of you were not there. So it's like today we will still start from what we had done. We discussed what we need to cover for this unit. We went through the course outline. I said that I advise you read ahead of the class. The notes have been there for quite some time since the semester today's topic. So I expect the theory part will move very fast because it's something I assume you have gone through. So I want to project the course outline. The first class, we were only like 9 of us. So we never did much. I avoided because I knew I'll have to repeat again. This is a course outline. The prerequisite to this unit is financial management. Those are the topics we are going to cover. We'll start with mergers and acquisition, which is what we should cover today. Then the introduction to behavioral finance, that is a term paper. I might not teach a lot about that, so I will avail notes. It's a theory. Then corporate valuation, which will be our next topic after mergers and acquisition. Then we have risk analysis in capital budgeting. We have financing decision. Then qualitative distress models, cryptocurrency, and that will mark the end. It's not very wide, but of course it is the one which is capturing all the emerging issues in finance. I know probably blockchain should be introduced in this unit, but not yet. Just I mentioned under the cryptocurrency. So this unit is the one which collects all the emerging issues in finance, and that's what we need to cover. The only thing I'll say that I might not teach a lot about is introduction to behavioral finance. It's theory, so we'll give a term paper, then I'll avail notes. That will be enough to cover that topic. I think that was just to show you the course outline is available on our virtual campus. You can take time and go through it to familiarize with it. I want to go straight to our content. Apologies, I have some cold, so my voice might be a bit affected. So we will start our content directly. I don't want to waste a lot of time. I'm intending to cover the whole of this topic today. So in our last class, we defined what is merger and what is an acquisition. Those were in the class. A recap for the people who are attending it for the first time, or even the ones who were not there, and you have an idea of what a merger is and what an acquisition is. Someone to define for us what is a merger, what's an acquisition, the difference between the two. What do we mean by a merger? What do we mean by acquisition? Someone to define. I said that I like. Yes, Kevin, go ahead.
So I'll try at the top of my head, not in the last class, but for me, I believe a merger is where two organizations combine to be one. And then for an acquisition is where another company acquires now fully another company.
Thank you. So when you talk of a merger is where two companies come together to form totally a new company. An acquisition is where one big company, which we'll be calling a predator, takes over another small company, which we'll be calling a target. That is an acquisition. So a merger is a bit friendly because both companies lose identity and form totally a new company. But an acquisition mostly is usually an hostile one. So the predator takes over the target company. So we have different types of mergers and acquisition. Before we go there, what are some of the examples of mergers in the economy, the current economy? And what are some of the examples of acquisitions? Practical one. A merger and acquisition, two companies which joined to form totally a new company. Examples? Yes, go ahead.
Types of merger.
Yes.
We have horizontal and vertical.
Yes, we have three types. So there's horizontal, vertical, and
The other one I can't remember.
okay, someone else to remind my friend the third one. There are usually three types of mergers. There's vertical, there's vertical,
Conglomerate.
conglomerate. I don't even like pronouncing that name. It's a bit hard for some of us.
That's why I've read it.
So what are vertical merger? What do you mean by a vertical merger? What do you mean by a vertical merger? What do you mean by a vertical merger? Someone to remind us, we discussed this, so I expect to move very fast. What do you mean by a vertical merger? What do you mean by horizontal? And the other one, which my friend is avoiding to pronounce. What do we mean by this? Vertical merger is where companies at different levels of product, just vertical, the way it says. Maybe I'm at the level of producing the raw materials, another one is at the level of distributing them together. Maybe I'm the producer of the products and someone else has been distributing. Then we join together, the company which is producing and the one which is distributing, so that you can have end-to-end chain of production. Then horizontal merger is where the companies at the same level of production come together and merge. That is, we are maybe we are distributors, we join. That's our companies at the same level of production or the same level in the business chain. Conglomerate is where companies in diverse industries or different lines of businesses, maybe a school merging with a supermarket, they come together and merge. This one is mostly for diversification of risk. Diversification of risk. These are businesses in different sectors. They come together and merge. This is horizontal is for increase of market share. Vertical is maybe to reduce risk, to increase efficiency, because it means you are producing, distributing, or you are producing the raw materials and you manufacture the final product. So those are the types of mergers and mergers in the economy. Now, I want us to give practical examples, the real life examples of mergers which has happened in the recent, in our country. What are some of the mergers you know which have happened? To give examples of mergers which have happened. I'll start off, we have the NIC CBA. That was a merger because the NIC lost identity, CBA lost identity. They formed a new company which is called NCBA. So this was a combination of NIC Bank and CBA Bank. Which
Can I
other
try?
one? Yes.
Coca-Cola and Pepsi.
What have they formed?
A merger, horizontal merger.
So which company have they formed?
That is acquisition.
As acquisition, Coca-Cola acquired Pepsi. That's why all the products of Pepsi are branded Coca-Cola now.
Yes.
This is an acquisition, but it's a good one because acquisitions are not many. Another one, another example which has happened in the recent in our economy. Someone else who has an example. We have mergers and acquisitions happening every day. Another example?
Good morning, Mwalimu.
Morning.
City Finance Bank merged with Jamii Bora Bank Limited
Yes.
to form Jamii Bora Bank Limited.
Jamii Bora. That
Yes.
one I'm not aware of.
This
So
happened in 2010.
So who lost identity in this case, or they formed totally a new bank?
They didn't lose, they agreed to use Jamii Bora Bank.
Okay.
Yes.
Another example? Someone was talking of
Yes.
someone is talking of KCB NBK. Is that an acquisition or what is it?
It is an acquisition.
Acquisition.
And then another one,
There's no one which has lost identity in this case. NPK is operating as NPK, KCB is operating as KCB.
but another one.
One was NIC and Commercial Bank of Africa to form NCBA Bank.
Yes.
That one we have already mentioned. Yes?
Another Molim.
Yes?
I'd rather to mention this one, the Mwalimu National Sacco.
Yes?
Mwalimu National Sacco acquired the ECB Bank and changed its name to Spire Bank. I don't know whether it's acquisition.
That should be a merger. When there's both of them lose an identity and form a new company, that's a merger. When one of them keeps an identity, that is an acquisition.
The Mwalimu National Sacco is still Mwalimu National Sacco, and then it acquired
then that's an acquisition.
It acquired the ECB, Equatorial Commercial Bank, and changed its name to Spire Bank.
That's an acquisition. I can see so many coming through the charts. There's NIC, CBA, to Mine Supermarket, to Quickmart Supermarket. So those are some of the acquisitions which are happening. It's good to be familiar with what is happening in the economy and have real life examples. Yes, Catherine? Can see your hand is up. Okay, so those are some of the examples. It's good to go look for others. Yes, Patrick?
Yes, Quickmart acquired Tuskys.
Okay, yes, Quickmart acquired Tuskys. I don't know whether they acquired or they just put businesses where they were. That one I've never confirmed, but if it confirmed, then they acquired Tuskys because Tuskys is no longer in existence. So what are some of the reasons someone would decide or companies would decide to get into a merger?
Empire Building.
To maximize.
Empire Building.
Empire Building, they want to be the rolling business in that area. So you acquire every other company in your area. Someone else?
Increase in financial capacity.
Financial capacity, that's financial synergy.
Improve market share.
We talked of market share. Something else, someone is doing it through chat. I would not prefer chat.
Tax saving.
There's tax saving. What else?
Diversification of risk.
Risk diversification. What else?
Madam, good morning.
Management efficiency.
Can you also say that the reason for mergers or acquisition is to minimize transactional, the foreign exchange risk, like when a company in one country acquires or merges with a company in another country, so that they don't do a lot of currency exchange when they are trading.
Yeah, it can be a way of managing your risks or exchange rate issues. Another reason? Another reason?
Synergy.
Synergy can be management synergy, financial synergy. So there are so many sorts of synergies.
And then operational synergy also.
And there's operational synergy. So those are some of the reasons. These are things we had mentioned in another class. Those are some of the reasons why companies might decide to be involved in mergers and acquisition. So there's a process of mergers. How do you go about it? Do you just wake up and start the process? So what is the process of a merger? or acquisition, if you are the company who is intending to do the merger or the acquisition, how do you go about it? The first step is what we call merger planning. You need to know the reason as a company why you need to acquire a company or why you need to merge with another company. We have just mentioned so many reasons, and the reason will guide you in shortlisting the targets. So what is the reason why we are intending to get into a merger as a company? Let's assume you are getting into a merger for diversification of risk. That means you get a company in different sector of the business. If you are in school or academic sector, you get a company which is in agriculture, such that if schools are closed because of corona, you can continue with agriculture because people will continue eating. So you have to sit down and plan the merger well. Actually, when we'll be talking of the reasons of failed merger, one of the main reasons is poor planning. You must plan what do we want, so you are able to know the process. There are several reasons we have mentioned. Maybe you want to increase your market share. That means you acquire all the competitors or you merge with your competitors in the market so that you can increase your market share. So you have to plan your merger well. The second step is search and screening. Search and screening. You have known the reason why you need to get into a merger. You search your targets and screen them. What do you look at when you are screening a target company? You have decided that we want to diversify our risks. You have decided that we want to diversify our risks. So you have gone out to the market. Am I audible enough? I request that people
Yes,
mute
you are.
unless you are responding
You
to a
are.
question, kindly be on mute. There's a lot of background noise. That's good. So we have said that you have planned the merger well, you know the reason why you are getting to a merger. After you get the reason for getting to merger, you search and screen a target company. You shortlist the companies you want to diversify risk, and this is a sector we want to venture in. You shortlist companies in that area. So when you are doing screening, what are some of the things you look at? What are some of the things you look at? Now let's assume you are the person who is leading the whole process of merger and acquisition. You have already convinced the management that these are some of the reasons why the merger will help us. Maybe you want to reduce competition, we want to build an empire, we want to be the only producers of this product in that sector. So you want to get a company or the companies in that business so that you can be the leading company in that industry. Then you go search and screen. How do you identify an easy target? Because of course, if you want to acquire, you must get an easy target. How do you identify an easy target? What companies do you think would be easier to acquire? Because at the screening level is when you might list companies. Some you realize they're even bigger than you. Others you realize they are very stable. They will not even agree to your plans. Some have good values of their shares in the market. So how do you identify?
You look at the financial performance of the company.
Yes, the first thing is financial performance. A company which is having financial distress is likely to accept a takeover. A company which is not liquid is likely to accept a takeover or a merger. So you look at the financial position or performance of the company. How are they performing? Later, we'll be talking of financial distress. If they are facing financial distress, they cannot pay their employees, they cannot meet their short-term liabilities. That becomes an easy target. How else do you identify an easy target? Which other factor do you think you can consider when you are trying to identify an easy target?
Mwalimu,
Yes.
can we say political goodwill?
What do you mean by that? Maybe you expound.
I mean,
Yes.
if they are in good terms with the government of the day,
Yes.
in terms of taxes,
Is it easier to acquire a company which has tax issues or the one which is okay with the taxes?
the one which is okay.
Yeah.
Yes. Which one is easier to acquire?
The one which is compliant.
It's easier to acquire a company which has liabilities with KRA. Because they will be looking forward. The other day when we were selling KCA, did you ask why we were selling? Some of you are members of ISPAC. Do you have members of ISPAC here?
Yes, we are.
Yes.
You can remember the day you came for AGM in the field and you voted to sell KCA. Did you ask
We
to
were
sell?
not.
There are these private investors who wanted to come and invest in KCA. Marifa. I know you have heard of Marifa story. Members of ISPAC who are here, if you were a member of ISPAC back in 2014-15, there's a special AGM which happened in the KCA grounds.
So cases is no longer fighting under ISPAC?
No, of course, it never went through. We will be discussing reasons of failed mergers because that one failed.
Okay.
And now I was just mentioning it because one of the factors which was pushing us so hard to sell it was about tax liabilities. You have tax liabilities, you are threatened by KRA. Would you better sell the company or keep it when there's a likelihood of being liquidated because of tax liabilities?
Better sell the company.
So tax liabilities is one of the things which push companies to merge. If the company is not in good books with KRA, that would mean they have tax issues. Some of even them, the directors will just pretend they have merged and change the identity of the company to avoid some tax liabilities. So it is easier to target a company which is struggling with tax issues. They will be so easy to dispose it off. Even the shareholders will be like, good riddance. Go and struggle with the liabilities. As we are safe now, I better get the few shillings I'm assured than staying with the uncertainties of whether I'll ever get anything from the company. Someone else is saying history of directors of the company, history of directors. How would that be a factor of an easy target? History of directors. There's some directors who have history of selling other companies. There's also issue of there are some directors who are very strong to take it over. Then there's a management struggle. If it's a company which is managed, which has issues with the management, it becomes an easy target. How else would you identify an easy target?
Another way of identifying, I think I came across this one in some article, where a company identifies a company that they feel is a threat to them in the market, but it's just an upcoming company. So they go and acquire it so that they minimize the competition.
Yeah, we said after you identify the reason, so you look at your threats. They might not be your competitors as at now, but they might be coming with the full force in the market. So they are threats of your future. You swallow all of them. So you look at your threats and target them. How else would you identify an easy target? How else would you identify an easy target? Those are some of the ways you can identify easy targets. Once you identify a target, you do what we call financial evaluation. Financial evaluation. And that's why now as a finance person, you come in. You look at after the merger, are we going to grow? Are we likely to achieve what we want? The estimated rate of return or the desired rate of return. In case it's a company which has shareholding, is the earning per share of the shareholders going to be up or it's going to be the same? So you determine the financial evaluation is very critical. You do what we call the last stage. We are just talking of stages of mergers and acquisition. We say the first one is merger planning, search and screening, then financial evaluation. You can read through the notes. I know there's a lot of theory in the notes. I just decided to go an overview. So it's just theory you can read. So the last, the other thing I want us to look at is the reasons for failed mergers. Why do some mergers fail? Give examples of some mergers which have failed in the market. What are some of the examples of mergers which have been attempted, but they never worked? After some years or some period, it doesn't work, and they demerger, and each company starts operating alone.
Lack of cooperation.
No, let's give the examples first. Then I'm trying avoid putting it in charts because it means I keep opening the chat unless you are really in a place where you cannot talk. So what are some of the reasons of failed mergers? I've said we give examples of mergers which have failed.
Always.
Sorry?
Stanbic Bank.
The CFC?
CIC.
CIC.
Yeah, CFC Stanbic Bank.
I know CIC has never managed with Stanbic. It was CFC Stanbic.
Yeah, they came to at some point, and then they demerged.
They demerged again, so the CFC and Stanbic.
The CFC Bank on its own, Stanbic Bank on its own.
Which are the example of a failed merger?
Malim, good morning.
Good morning.
The one for Nokia and Microsoft.
Nokia and Microsoft, which never picked. Did they demerge or they stopped?
I believe Nokia bought all its stake again from Microsoft. So we have strong directors, as you said. We can have strong directors.
Sorry?
I'm saying,
yes.
Nokia was able to recover from the takeover from Microsoft. So it never took. It's the same case where you said we almost sold. KCA ISPAC members almost did a bad deal back in the days, but they recovered.
Okay, so Nokia and Microsoft, because that one never worked. Nokia was in the market. When they merged, it never worked completely. So they demerged. Which other example?
Mwalimu also Airtel
and Telcom.
Airtel and Telcom. Who was merging with who?
Airtel was merging with Telcom Kenya.
Yes.
But they never managed to merge.
Yes, so those are some of the failed mergers in the economy. Anyone else with the most recent one? The only most recent I remember is this CFC Stanbic. Is there another one which has not worked? Very recent in the economy. Do we have any? Which they tried and it did work? Any? It's good you familiarize yourself with that. You go read about it. The most recent one there is something which happened with Old Mutual. What was it? Was it a merger or was it a demerger in the insurance industry? Anyone who is in the insurance industry?
I'm not there, but old mutual. In fact, it's still there. It's still existing.
So did it acquire another company or what happened? Because I remember there was some time back they were trying to do something.
It acquired a UAP.
It acquired the UAP.
Yeah, UAP. So it's now all mutual. Yes, it's currently building as UAP all mutual.
Okay. So those are some of the things. So what makes a merger fail? What are some of the reasons of failed mergers?
I can try, Mwalimu.
Yes.
Where some of them might lose the focus on the desired objectives.
Okay, poor objectives, some lose of focus. Okay, another one?
Lack of cooperation.
Lack of cooperation. From which side? Of course, the target
Either
will not
side.
just sit and wait to be acquired. They will try to resist. So you expect there's some resistance, that is a resistance from the target.
Inappropriate valuation.
Poor planning, valuation.
Mwalimu, can we say lack of cultural fit?
Yeah, cultural fit. What else? What else can make a merger fail? Everything has been done. We are the point
Can
of
we
merger,
say,
but it doesn't work.
can we say hidden financial problems?
Yes, sometimes if we are also waiting to be taken over, we can trace our books. We don't tell you of some things, then you take it over, you realize there are other issues later. So what else could lead to?
Mwalimu,
Yes.
do we have something like forceful acquisition, and can it be a reason of failed mergers?
That maybe will fall under the resistance from the target, because if you're using force to acquire, then the target will resist.
Okay.
We call them hostile takeovers. If you decide to carry out an hostile takeover, the target can resist, and that can lead to fail. Some targets even go to court and stop the process. So they can even seek legal intervention for them to stop the process. Pia there's a poor fit. You might get a target who does not really serve the purpose you wanted to acquire for or to merge for. So those are some of the reasons why a merger might fail. I know I've listed several in my notes, so you'll have good time to read through. How can a company resist hostile takeover? So that we can now go to computations. You know me, I thrive well in teaching calculation. I prefer teaching calculation than theory. So how can you resist a hostile takeover?
Selling the assets, like the major assets.
Resisting an hostile takeover. You sell the target asset, the asset they are targeting. Just a minute.
Just resist.
Okay, sorry for that.
Just say no.
How do you resist to an hostile takeover? As someone who had mentioned you sell the targeted asset, maybe they are targeting a specific thing in the company, so you sell it off to discourage them.
It's called the removal of the crown jewel.
Yeah, the crown jewel. Whatever they are targeting, you sell it off. How else would you resist a takeover?
Using a
Seeking
white knight.
counter offer. Make a counter offer.
You give a counter offer of taking over the predator, or you look for a company which will take you over a friendly takeover.
You seek
Another one,
legal redress.
there's legal intervention. If you cannot do any one of the above, you go for legal process. Another way,
You can also heavily indebt the company so that you make it unattractive.
yeah, you get into debt.
Yes.
You borrow to make the company very unattractive. That's another way, because once they realize you are in debt, they will not be attracted again. Another way is which one? How else would you resist a takeover, a hostile takeover?
You can also offer yourself to another company so as to avoid the one that wants to take you over by force.
You offer yourself for a friendly takeover, that you go to a company which will take you over, which is a bit friendly. Use of poison pill, what does that one mean? I know here it uses very big terms. Pacman defense, this is where target makes a counter offer. So those are just the same things we are talking of, but I know here they are big terms which would explain the same thing. So those are some of the methods a company can use. Whether you answer them with a simple term or with the tough terms, it all means the same. So don't struggle cramming those hard things. Just understand the concept. If you are selling the most attractive asset, then it's just selling the most attractive asset. About the crown or the ground, whatever it is just explaining the same. So don't struggle with the hard terms there in the notes, but just get the concept. How can you resist an hostile takeover? You sell
you,
whatever
madam.
you want, you give a counter offer, and all that. So the last part of the mergers and acquisition is the computations part. Once you have decided and settled on a target, we have said kindly be on mute unless you are answering to something. Kindly.
Collins, mute.
The co-host, Janice and Hilary, in case anyone is talking, help in muting, because you can do that. That's why the class is big. We are close to 92. So if everyone decides to be unmute, we'll not be able to have a class. So the last part of the mergers and acquisition is now you have settled on a target and you want to know, we want to take over this company. How do we compensate the owners of the company? How do we compensate the owners of the company? Or how do we buy the company? There are three methods of buying the company. One is payment in cash. Payment in cash. You can decide to take money from your company. You are the predator now. And buy off all the assets and pay back the shareholders of the other company. So you pay by cash. But this one has its own shortcomings. What are some of the disadvantages? You do imagine they will come with it. What are some of the issues which you expect? If as a predator, you decide that I'm going to buy everything in cash. I'm going to do a valuation of this company. Of course, if it has shares listed in the stock market, you expect to be knowing the value of the shares because they are listed in the stock market. So I'm going to buy off all the shareholders. I'm going to buy their assets, all of them, in cash. What are some of the implications of this mode of payment, compensation to the target? If you decide I'm paying them in cash, Yes, James?
I think in such a situation, there is no record of transaction for future references. So even the target might be disturb you later
Why
because they were
would
not.
there be no records? You will do other records.
You know, with cash payments, normally
Cash
they are
payment
not.
does not mean a liquid cash. It can be even a bank transfer to all the shareholders. So there will be an evidence you transferred money to them.
Only
They
what about we say taxation might be an issue?
Why would it be an issue? When you say
Say
a point,
if
defend
you
it.
do
Yes.
Okay, yeah. So when you decide to use cash to acquire property, maybe you'll have to pay more because the other company you're buying the shares from, they want to recover the tax burden, say the capital gains. For example, the capital gain, they want to recover it from you as the predator.
Yeah, sure. That one is
opposed to when maybe you yeah.
because if you are buying shares from the target, they will realize capital gains which may be taxable and which will be on you as a predator. Because you are going literally to buy their shares. If their capital gains, it is you to pay the tax on the capital gains. But which other disadvantage would it come with? Either to the target or to the predator.
Another thing, Mwalimu, we can say is there will be a huge cash outflow, which may cause liquidity challenges to the company that is predator.
Yes, a huge cash outflow, which can lead to liquidity issues. Another one, the target shareholders will lose control. They will not have any control because they have lost the ownership of the company. They will be compensated, so there is nothing else they will claim from the company. So they even lose the future dividends from their company. What else? What other disadvantage do you think of? What are some of the advantages then it will come with if we decide to do the transaction in cash?
The other disadvantage is that if it is not carefully planned and thought of, it can lead to the fall of the predator company as well.
Yes, it can. Actually, some of them which pay in cash, they don't sustain the future because of the liquidity thing we have mentioned. Some even die within a month or years. It cannot survive again. Remember, we said one of the reasons for failed mergers is poor financial planning. And this can be one of the poor financial planning. If you really don't have a lot of disposable cash, then it's not an advisable method of compensation. So what are some of the advantages it has if you decide to go for cash? What are some of the advantages? There is no dilution of ownership in the predator company. So the shareholders of the predator company are on a good position or a better position because their ownership is not diluted. Then the shareholders of the target company, they dispose their shares without incurring any transaction costs. Those are advantages to the shareholders. So those are some of the advantages. Then the shareholders of Target, they receive a value for their shares, which they can invest. Maybe their company was even dying. So if they get a takeover, it releases their money, the way I was saying, in cases of taxes and all that. It's a good returns to them. They can get their money and invest in a riskless or a risk-free securities. So those are some of the advantages which come with the payment in cash. But of course, for
Madam, can you also say that it relieves them of their financial obligations? Like when the takeover is done, the predator takes over the liabilities and assets of the company as in totality.
Yes, it also relieves the shareholders because they are no longer interested. They are no longer owners. They are no longer part of the company. So it releases them from any liability which was there. So those are the advantages and disadvantages of the cash. But of course, from finance, if you don't have a lot of disposable cash, there is not an advisable method of compensation. The other method of compensation is where you give share for share exchange. It's what we call share for share exchange. Share for share exchange. If you identify a target, you decide how many shares you are giving or what percentage of shares will you give. That's what we'll be calling an exchange ratio. How many shares will you give for each share held in the target? So it's Predator who determines the offer price. They give an offer price, which will determine how many shares they are going to get to give for each share held in the target. That is share for share. And in this case, where we give share for share, it means the owner of the Predator, the ownership is diluted, because it means there are more shareholders who are coming in from the target. So the ownership is diluted. But the good thing is it doesn't commit cash flow at that point. So it cannot lead you to liquidity problems. The other thing also, which might, it makes easy to acquire the process, because the target shareholders will not resist. The case of cash, the target shareholders can resist because they know they are losing their future returns from their investment. So they can resist. But in this case, they know that they are not losing their control. They are not losing ownership completely. It's only that it's changing from one company to another. So that's some of the advantages of going for share to share, share for share. But the major disadvantage is the dilution of the ownership of the shareholders of the Predator, because they are going to bring in several new shareholders. There's the one share for share. We are going to see how you determine the offer price and the offer price which the Predator can give to avoid diluting the earning per share. So you are going to talk of earning per share, the price earning ratio, and how you can keep it at the same level such that you don't dilute their returns, even though you are diluting the ownership. The other method of compensation is what we call using of debt, either preference shares or convertible debentures. What is the difference between ordinary shares and preference shares? What is the difference? Of course, I know there are different types of preference shares, but what is the difference between the two, preference shares and ordinary shares?
Ordinary is equity ownership, preference shares is debt.
Sorry?
Ordinary shares are equity owners, but
Yes.
preference shares are debt. They have interest that is paid or every month, and then at the end of the day, you have to refund the money to the owner.
Yeah, that's only the difference, that preference shares, they have fixed returns which must be paid every financial year. So it's more of a debt, it's more of a liability. But the ordinary shares is the equity ownership of the company. So when you talk of use of convertible debentures and preference shares, that's use of debt to finance. Like you sell preference shares, but it doesn't dilute the ownership. That's a good thing. If you use the debt, there's no dilution of the ownership, but it brings more liability to the company. So we are going to look at the share-to-share exchange. Share for share exchange. How do you determine the offer price? Or how do you determine the price at which you are not diluting the returns of the Predator company? That's what we are going to, and we are going to look at it at the evaluation. Remember, we talked of financial evaluation. So evaluation of mergers. We have said when we are talking of share to share, you have to know how many shares you are going to offer for each share held in the target. And that is what we call the exchange ratio. Anyone who has read the note and has the formula for the exchange ratio, I want us to get the formula, then we do an example, then we'll be done for today. So you bear with me. I don't normally take long in the class, but because we missed the last class, we must compensate. We are still within our time. Or we take a break for 5 minutes. Who says we take a break?
No.
Not when I want an information overload. People are different.
You can continue, Mwalimu, then we finish early.
Okay. Thank you. So we are saying that you have to know the exchange ratio so that you can know how many shares you are going to offer to the shareholders of the target. So the exchange ratio, just a minute. So the exchange ratio equals to the offer price of Predator divided by the pre-merger, the market price of the Predator before the merger. Just a minute. Who has read the notes? Kuna mtu amesoma notes kweli? So that's how you determine the exchange ratio. You take the offer price, which the Predator is giving to the company, to the target, divide the market price per share of the Predator before the merger, that is pre-merger, MPS of the Predator. You will be able to get exchange ratio. So once you get the exchange ratio, you can know how many shares you are going to, how many more shares, ordinary shares you are going to issue. The offer price sometimes is usually above the market price of the target. Like for example, let me get a new page. For example, let's assume you give an offer price. The target, let's have a target here, which we are calling A. We have a Predator here, which is B. So you have the market price per share of the companies. Here it's 20, here it's 40. Then Predator decides to give an offer of 25. That's the offer price. What will be our exchange ratio? So that I can show the other thing I wanted to show. What will be our exchange ratio? What will be our exchange ratio?
0.5.
How did you get to that?
Offer price of the target. No, I think I made a mistake.
Is the offer price of the Predator, which is this one, divided by the MPS of the Predator, which is 40. So what will be our exchange ratio?
1.25.
1.25. That cannot be 1.25. 25 divided by 40.
0.625.
0.625. 0.625. This, what does that one mean? It means for every one share you have in the target, you are going to get 0.625 shares in the Predator. So they are not exchanging a share for a share. Every one share you have in the target, you are going to get 0.625 shares in the Predator. So if you had like 3 shares, let's assume you had 3 shares. Let's assume you had 3 shares in the target. You are holding like, let's say 100 shares in the target. You are going to get how many shares? You multiply by the exchange ratio. So how many shares will you get?
62.5.
So you will lose some number of shares, but now it will be having a higher value. Remember the market value, the MPS was 20, but now it will be at 25. So the difference between the offer price and the target price, the difference between the offer price of the Predator, seem to have a challenge with my board. The offer price minus the MPS of target gives you what we call the premium. And this is more of a capital gain. Someone had mentioned capital gain. Kuna mtu alikuwa ametaja capital gain. This is the premium. They are going to get, like now in our case, our offer price was 25 minus 20 equals to 5, which is the premium per every share you are holding. I'm just highlighting some of the formulas we'll be using if we are considering share for share. So now we have talked of exchange ratio. We have talked of the premium. So the total premium that the target shareholders will get, that's the total premium, will be equal to the premium per share times the number of shares of the target. So that is the total premium that the target shareholders will get. Then you need to know, one of the things that a management should make sure is that they don't dilute the earning per share. They don't dilute the earning per share or the price earning ratio of the company. You should make sure that you don't dilute the earning per share of the existing shareholders. So how do you make sure that you don't dilute the earning per share? You must accept our offer price, which will leave their earning per share to be the same. So the formula we use to calculate the non-diluting offer price, we will do this practically. It will make more sense when we are taking an example. Non-diluting offer price. So as a target also, or as a predator, you must make sure that your existing shareholders, they don't become resistant to the acquisition. How do you make sure that you don't, because they know they are diluting ownership, you make sure the earning per share is not diluted. And the offer price, which will not dilute the earning per share, how you compute it is a price earning ratio, that is PE. So I expect people to be knowing how to calculate the price earning ratio of the predator times earning per share of the target. This is what will give you the best offer price. So if you are in the finance and you are the one leading in the acquisition, you make sure that the offer price given does not dilute the earning per share of the predator shareholders. Because if they realize that it's diluting the earning per share, then they will resist. They will resist the management decision or move for the acquisition. That is why ISPAC they approved the acquisition of KCA University. But at one point, they used the treasury to stop it because they realized they might not be getting anything from the company, but they will lose it completely. It will no longer be within their control. So when the shareholders realize that they are losing the control and at the same time they are losing their returns, they are likely to resist. So you must make sure that the offer price you are giving to the target does not dilute the earning of the shareholders of the predator. I think the other formulas, will pick them as we go through the example. There's so many formulas if you have gone through the notes, but I think it will make more sense if we get the example. Let me project the example. Anyone who has downloaded the notes?
I have.
Okay. I said I'm not good at dictating notes. Let me see where. There are several formulas if you have gone through the notes. Let me project the notes so that we can look at the question. It will make more sense if you look at it in an example. Then Are you able to see my notes? Is it the same note?
Yes.
Okay, let me get to the example. So these are the formulas I'm talking about, post-acquisition, earning per share. There are several formulas, but let me go to the example, we apply them. So the example is here. I can read. I don't know whether you're writing it down or you have the notes. So that will determine the speed we'll go with. I do have it in the notes. Are you having access to your notes?
We do. Yes, we have.
Yes.
Some of us don't, Mwalimu.
We have access.
But we are
I don't
accessing
have
the
access.
classes. We are accessing class through virtual campus. So just download the notes.
It
Was it-
has refused.
Yeah, we
I
have
can't
the
even-
note.
You can screenshot.
Just
No,
screenshot
I
it. and-
mean, we
They
can
can screenshot.
enroll.
How did you get to the class? Because the class is being attended through virtual campus.
Yeah, I got the link, but we can't enroll because it said the maximum, it has reached maximum enrollment. It's refused. That's the problem we're having.
Okay, and I'll check at it. I think it's a maximum of 100. This class was not expected to go beyond 100. So I will read, but you can be copying. It's projected there. So you can take some few notes. Max Limited is considering acquiring Mini Limited. Selected financial data for the two companies is as follows. Annual sales, I just write sales. For Max is 750. For Mini is 90. Net income, that is the returns. Earnings, for Max is 60. For Mini is 7.5. Ordinary shares outstanding, this is the number of ordinary shares outstanding. There is 15 and 3, respectively. Earning per share, that is EPS, is 4 and 2.5. Market price per share is 44 and 20. So for those who don't have notes, I'm giving you some seconds. You copy that information because you need to have it for us to follow in the computations. So that's the information you are given. Max is the predator, Mini is the target. We have the earning per share, we have the market price per share. So I want to go to the questions which you are supposed to tackle so that we can know how to apply all these formulas. These are the questions we are supposed to tackle. Calculate the maximum exchange ratio. Max Limited should agree if it expects no dilution in the exchange per share. Calculate the maximum exchange ratio. Let me get a screenshot so that I can go to the whiteboard. Just a minute. Just the best, you can take a photo and have it, so you'll be consolidating your notes later. So those are the questions. We want to start with question number 1, which says that we calculate the maximum exchange ratio if we want to make sure that there is no dilution of earning per share of the predator. We don't want to dilute the earning per share of the predator. So we want to look at an offer price, which will make sure that we don't dilute the earning per share. So those who can remember the exchange ratio formula. Kindly mute. The class is big. If we have everyone unmuted, we will not communicate.
Excuse me, Mwalimu.
Yes.
I muted you by mistake. Sorry.
Yes, I mean, sorry, you know, it's a weekend and everyone imagines that I'm free. Eh? So wanapiga piga simu. Next time I'll make sure I switch it off. So we were looking at the first question was what? I want to copy the
Exchange ratio.
the exchange ratio. In other words, is non-diluting exchange ratio. Exchange ratio. The exchange ratio which will not dilute the earning per share of the predator's shareholders. How to calculate exchange ratio?
Offer price by the predator
Equals to overprice
by the predator
by predator
over
divided by
pre-merger MPS of predator.
MPS of predator. Pre-merger. So you need to be sure that you use the MPS before merger. MPS of predator. So in this case, do we have the overprice? We said we can calculate what we are calling non-diluting overprice. How do we calculate the non-diluting overprice? We have just given a formula. Non-diluting overprice. We said, how do we calculate it?
Price earning ratio of predator
P of the predator
multiplied by the earning per share of the target
times EPS of
the target.
So what is our price earning of the predator? How do we calculate the price earning? We need to get the P of the predator. How do we calculate the price earning ratio? Price earning ratio equals to share price, that is MPS, divided by earning per share. That's how you calculate the price earning ratio. So in our case, what is our MPS for the predator? From our question, what is MPS of our predator?
44.
44.
So MPS is 44 divided by earning per share is how much? Sorry?
For the predator.
So what is our price earning ratio?
11.
11. So back to our formula, we needed price earning ratio times earning per share of the target. What is our earning per share? So it will be 11 times
2.5.
2.5. So what will be our non-diluting overprice?
27.5.
27.5. So this is our overprice. Remember the question was asking non-diluting exchange ratio. Now we have computed the offer price and we have the MPS of the predator. So what is our exchange ratio? Our exchange ratio. Exchange ratio, we said equals to exchange ratio equals to overprice
by predator
Divide by
Offer price of Predator over MPS of
yes.
Predator.
Now we have the offer price is 27.5. Divide by MPS, which is 44. So what is our exchange ratio?
0.625.
0.625.
0.625. So this would mean this is a non-diluting exchange ratio. So that one you'll have answered the first question. What is our second question?
Excuse.
Yes.
Was it of the EP? Is it the target or the predator?
Predator. So with that one, what is the second question?
How much premium would the shareholder of Mini Ltd receiving at this exchange ratio?
Question 2 was about premium. Premium. The target shareholders will get. So we said premium equals to offer price minus offer price of target minus MPS, pre-merger MPS of target. So what is our offer price in this at that exchange ratio? 27.5 minus what is our MPS of the target?
Just a minute.
20.
20. So the premium is 7.5 per
Yes.
share. So what is the total premium? You multiply the premium per share times number of ordinary shares. That will give you the total premium. Are we together? Ama nimepoteza wengi?
Pardon, mwalimu.
I'm trying to see how I can share a new whiteboard. This one seems to have reached the last page. So we are saying that how we calculate the premium to the target shareholders, you get the offer price minus the MPS of the target. From the data given, the MPS of the target is 20. And the new calculated offer price, which we have just calculated, is 27.5. So 27.5 minus 20, you get premium of 7.5. 7.5 per share. So if you want to get the total premium, you multiply 7.5 times the number of shares. So 7.5 is per share. So to get the total is 7.5 times 3 million. So what is the total premium? What will be the total premium?
22.5.
Sorry?
22.5.
92.5. 92.5. What is the next? 22.
Mwalimu, excuse me, Mwalimu.
Yes.
Is that whatever has been shown as the ordinary shares outstanding, it is in shillings?
No, it should not be in shillings. It's just a number of shares. Just a minute, I confirm. Sina swali hapa, ngoja niangalie. It's number of shares, it's not shillings.
No.
Just take it as number of shares, not shillings. But imeandikwa tu ordinary shares outstanding. It's not shillings.
Ordinary. Oh, okay.
Shares
Okay.
outstanding, not
Thank you.
shillings.
Thank you.
So what is the next question? I know there
Max Limited's post-merger CPS.
Sorry?
Calculate Max Limited's post-merger EPS if the two companies settle on a price of shillings 24.2.
So we are supposed to calculate post-merger EPS if the offer price is
24.2.
Now we have a new offer price of 24.2. So the first thing you want to know is the exchange ratio at this offer price. So you should calculate the exchange ratio because it means the ratio will change. The offer price is different. So what is our exchange ratio? What will be our new exchange ratio? Because the offer price has changed. So we have to calculate the new exchange ratio. What is our new exchange ratio?
24.2.
Sorry? How do we calculate the exchange ratio? Tumesema is the offer price, which is 24.2, divided by
market
MCS,
price of the predator.
which is 44. So what is our offer price? How does our exchange ratio?
0.55.
0.55. That's our exchange ratio. So it means for every one share you have in Mini, you are getting 0.55 shares. So what is the total number of shares they will issue? In the Mini we have how many shares? We have 3 million. Are we together? We have 3 million shares. And for each one share, you are getting 0.55. So for 3 million, how many new shares will they issue? How many new shares will they issue?
1650 million. 1650,000.
How did you get to that?
You divide.
3 million times 0.55.
3 million times
0.55.
0.55. So how many shares are you going to issue?
1,650,000.
1,650,000. 1,650,000. Na mkumbuke I'm relying on your figures. Sina calculator mimi. So if you give me wrong figures, 1,650,000. Evo.
Yes.
So those are the new shares they will issue. So in total, how many shares will Max have in the market now after they issue the new shares? There's the original shares they're having. How many shares do they have before the merger process?
15 million.
15 million.
15 million. And they are going, you can convert this figure to millions. Just a minute. So they already have, Max has 15 million. That's 15. And they are going to issue 1.65. We were to convert to millions. So how many shares will they have in the market?
16.65.
16.65. Are we together up to there?
Yes.
Yes.
So they are going to have how many shares trading in the market? 16.65. Those are the new shares. So let's assume there's no synergy. When you are calculating the post-merger EPS, there's some assumption we say, if the worst scenario happens and the earnings remain the same, what will be the total earnings? That we don't realize more earnings because of the synergy acquired, because of the acquisition. So the earnings remain the same. What would be our total earnings? Earnings for Max is how much? All the total earnings for Max? Earnings from the data given. What is the total earnings for Max Limited?
60 million.
60 million.
60 million plus the total earnings for the target is how much? 7.5.
7.5.
So if the worst scenario stands, that will be our earnings. Total, the combination of the two earnings, divide by. How do we calculate earning per share? Maybe I needed to give the formula for earning per share before getting to that. How do you calculate earning per share?
Total income over
Total income over
ordinary shares.
Total earnings divided by
Ordinary shares.
ordinary shares. So here we are looking at total earnings, which is combination of the two earnings divided by the total ordinary shares, which we have calculated to 16.65. So what will be our earning per share? The post-merger earning per share will be how much?
4.05.
4.05. So that's how you calculate the post-merger earning per share. Does it dilute the earning per share for the predator? Does it dilute the earning per share of the predator?
No.
No.
It actually increases because the earning per share of the predator is 4. So if they are getting 4, the earning per share becomes 4.05. It increases the EPS of the predator. That's how you calculate the post-merger earning per share. What is the next question? What is the next question? What is the other question? There's a lady who was reading for us. Umepotea?
Calculate post-merger MPS of Mini and Max Limited if the two companies settle on a price of shillings 24.2.
Post-merger MPS of Max and Mini. If the offer price is 24.2. So what will be the post-merger MPS of the two companies if the offer price remains to be 24.2? From the notes, there's a formula given for the post-merger MPS. Who managed to see that formula? Who might have seen that formula?
It's pre-merger market value predictor.
I want to project it so that people can copy it. Let me see whether I'll trace it. Just a minute, I trace where the formula is in the notes. So that's a formula for the post-merger of the predator, which is the Max. There are active people on the name. If you write on chat, just be sure that it will take time before I see it. There is a Simon Mwanza. What is the issue? Whatever you have written, I cannot read. Okay, this is how you calculate the post-merger MPS for the predator. That is pre-merger market value of predator plus pre-merger market value of the target divided by pre-merger number of ordinary shares in predator plus shares issued to acquire the target. So in that case, what is our pre-merger market value of the predator? It's MPS times EPS plus, so what is our MPS? Plus pre-merger market value of the target, which would mean the MPS of target times earning per share. Market value, how do we calculate market value? You know how to calculate. So divide by, so let us calculate the market value of the predator. What is the market value of the predator? What is MPS? 44. Tuko pamoja?
Yes.
Ama tumeachana kama Jubilee na nini? Let me go to my whiteboard. Hope you have copied the formula because I want to use somewhere where I can write. How do we calculate market value of a company? The gurus of finance in class, how do we calculate market value of a company? So we have said we need to get the market value of predator plus market value of target divide by the ordinary shares of the predator plus the number of new shares issued. So we will need to fix these values and we get the MPS for the predator. Shares of the predator plus issued shares to target. So what is the market value of the predator? How do we get the market value of the predator? MPS times the number of shares. I had written EPS, but it's number of shares. Plus, so what is our MPS? 44 times 15. Plus, what is the MPS of the target?
24.2.
That's the offer price. From the information given, what is the market price? What is the market price per share of the mini limited?
20.
20 times 3 million. That's how you get the whole value of the shares in the market. This is 20 times 3. Divide by what was the number of shares in the predator before the takeover?
16.6. Before takeover was 15.
15 plus the new shares issued, which is
1.65.
So what is MPS of Max post-merger? What is MPS? What are you getting as a market price?
43.2.
Sorry?
43.2.
43.2.
43 point?
24.
43.24. What does this one communicate to you as a shareholder of the Max Limited? What are you losing as a shareholder of Max Limited?
The market price per share.
The market price has reduced by 0.76.
The market price per shares
Has reduced by 0.76.
Yes. And what does that one mean to you as a shareholder? You are losing on capital gains.
Capital gains.
So how do we calculate the post-merger MPS of the target? Anyone who has seen the formula? First merger MPS of the target, how do we calculate it? How do we calculate the post-merger MPS of the target? We get the
Post-merger
post-merger MPS of the predator
times the exchange ratio.
times exchange ratio. This one we already have is 43.24. What is our exchange ratio? 0.55. That was our exchange ratio. So we calculated
Yes.
the exchange ratio.
0.58.
So what will be our MPS in this case for the mini limited? What will be our post-merge MPS for
3.7.
3.79? 23.7?
8.
What does this one mean to you as a shareholder of the limited? What does that one mean to you? You are gaining, eh?
Yes. No dilution.
Yeah, so that's how you calculate that. What is there another question we have not tackled? Kuna ingine? Read the other one. How many more are remaining?
2.
Okay, read one.
Calculate Max Limited EPS if many shareholders accept 12% convertible preference shares. In bracket stated value shillings 100 for every 5 ordinary shares they own.
Okay, let me get it. Let me get the question so that I can summarize. It seems to be introducing other things. Or preference share option. If they decide to go for preference share, there's a financing method. If they decide to go for the preference shares, there's a financing method. They're giving one preference share for every 5 ordinary shares. Is that the question? I'm reading other things. Ndio hiyo. Calculate the max limited earning per share if the mini shareholders accept 12% convertible preference shares, stated value of 100 for every 5 shares they own. So they're accepting 1 share, which has a return of 12%. The value of the share is 100 bob for every 5 ordinary shares they are holding. So we are supposed to look at if they decide to finance the acquisition using preference shares. Tuko pamoja? So we said you can use a debt, you can use equity. Now we have looked at equity. Now we want to look at the option of preference shares. So one preference share is going for 5 ordinary shares. How many shares are there in the market? Ordinary shares do they have in the market? Do we continue or do you have information overload?
No, let's finish, Mwalimu.
No, I don't like finishing for the sake of it.
Inakuwa mzito.
I don't like finishing for the sake of finishing.
Allow us to digest that, Mwalimu.
These are a small piece remaining for preference shares, which we can tackle and introduce valuation in our next class. I really wish to finish it, but I don't like finishing for the sake of finishing. So something which will take like 10 minutes in our next class. We do the last 2 questions. The last part is theory about the merger. You can read on your own. So next time we meet, we just talk of how to finance the takeover using preference shares. That's like a small piece which will take like 20 minutes. Then we go to corporate valuation. I've already uploaded notes for corporate valuation. So that's the next topic. I think let's leave it at that. If I'm feeling overload, what about the student?
It is what over here.
Mwalimu? Yes?
Mwalimu, you are correct. You are very right.
I want to raise a concern here.
Yes.
Some of us can't access Moodle because of the maximization
That
limit.
one I'm correcting right now. I think I underestimated the class.
Okay, thank you so much.
Should be able to enroll immediately.
So thank you so much.
So let me
Before
fix
you,
it now.
hey,
Yes.
Mwalimu, before you call it a day,
Yes.
I'm wondering if you had recorded this class.
Sorry?
I'm asking if this class was being recorded.
Yes, there are
Yes,
two
it
people who
was.
are recording.
Okay.
But don't send it on WhatsApp kindly. Get a group where you will put it.
Yeah,
WhatsApp itakrasisha simu bana.
Okay, I suggest you will post this recording on the virtual class so that we can verify it later.
I don't know whether the student can post, unless I give one of you administrative rights. Ngeno, we can talk after class, and maybe on Monday I give you administrative rights. For this
Okay,
one,
so
you can do through
thanks.
WhatsApp, but future don't do through WhatsApp. Inajaza phone unapata ifanyi kazi.
So I'll look for you on Monday then. Thanks.
Yeah.
And you share.
Of course, if it's on the virtual campus, it would mean everyone can access, and the virtual space is bigger than. Alternatively, you can create it on your YouTube and you direct us there. The virtual space is big. You cannot compare it with the phone. So that one will work with the Ngeno and get a solution. I'm trying to fix the one who are complaining about the Moodle so that I don't forget immediately I leave class. I didn't know why you guys preferring virtual classes.
Location.
Hey, mwalimu, mahali tuko.
Finance unafaa ukuje class uone mwalimu wa high to high.
Saizi niko Mutomo. Niko Kitui Mutomo mwalimu. Nitafika aje? Huko hakufikangi gari, unaenda na nduthi.
Anyway, I'll make sure that I fix it. I'm trying to see. Okay. So you will be able to enroll. I think I underestimated the class. I thought it's 100. So I'll expand that and you'll be able to enroll.
No, become this time we are on high demand. Become this time we are on high demand. The class
I've never had such a size of the class. I've never. I've never. Hata sasa ni kama nitaanza kujipanga vile nitamaka. But it's okay anyway.
There is a first time
when you are complaining of any student and when you are saying I don't have. So the rest of you can enroll. I've expanded the limit.
Mwalimu.
Thank you.
Yes.
Alternatively, you can let them send the ones who are recording. Let them send you to your email and then you update it on virtual campus.
Sure. That's an option. Let me have it on my email. Let me have it on my email. Then I will
just share the email for WhatsApp group and then they'll be able to share to you and then you update it on virtual campus.
Yeah, sure. That can solve it easily. Sawa. So the people recorded, let me have the recordings. My email is on the chat. I will also put on the group so that we can be together now. Think we can call it a day. Let's meet next time, the next Saturday. Same time, let's join class early.
Have a nice weekend and a nice week.
Thank you.
See you, Mwalimu.
See you, Mwalimu.
Okay.
Tuonane.
Last semester we were together. This semester again.
Mtaonana wapi? Mwalimu hebu waulize mtaonana wapi?
Tuonana class.
Acheka.
Kwa biu sasa.
Sawa.
Ni tu kuonana.
A nice weekend, guys. Nice weekend.